UnitedHealth is down 23% in just one day. Absolute disaster. After reporting earnings, they reported 26 to 26 and a half in earnings per share guidance for 2025. And the analysts, they were expecting, I believe, 29 and a half to $30 per share. No one was expecting such a massive cut in guidance for United Healthcare, as United Healthcare stock was well known for a company that's a recession-resistant stock that's going to be safe from the tariffs and safe from recessions and safe from weakening dollar and safe from all those things. But that didn't really happen. And United Health is down 22% in just one day. So in this video, I'm going to do my best to keep it short. As always, I'm going to let you know my opinion on UNH, look at some numbers, give you my fair value, and let you know if I believe UNH is presenting an amazing buying opportunity right now, as maybe we have a recession in 6 or 12 months, and UNH stock does very well as a flight to safety kind of stock, or maybe UNH is still overvalued and we should wait for a lower price. So I really hope you enjoy it as always. Now for United Healthcare, they have two main divisions, which is United Healthcare and they have Optum. Optum is my favorite part of the business. It's still expected to grow double digits and they have operating margins of 8 to 10%, much higher margins, I believe, than the insurance business itself. And Optum has many different divisions, but one division is called Optum Insight, which is mainly like a software system for healthcare, where they scrap all the old software system and they upgrade the healthcare kind of system with payment processing softwares and a few other things. I believe that's what it is. I'm not too sure, but it's an amazing part of Optum Health in general. And they had a $33 billion backlog in 2024 alone. And every single year, the backlog keeps on going up and it's much higher margins, much higher revenues. And it's an amazing part of the United Healthcare Group kind of company. Now, despite everything that's happening in the short term, over the long term, United Healthcare has been very resilient and they never had a single year of declining revenue growth. They never declined in revenue growth. They grew revenue almost every single year, from $25 billion in 2002 to $450 billion expected for 2025. This is insane growth from a company like UNH. And UNH is very well known for taking most of the free cash flow and giving it back to shareholders through share repurchases and dividends. They do some buybacks. Recently, they haven't been doing a lot, around 1 to 2% of the market cap every single year. But before that, they used to do 5 to 6%. Now they're only doing 1 to 2%. And United Health, with a 6% free cash flow yield and over $34 billion in cash, is in a very good position for them to ramp up buybacks, buy back at such lower prices, and increase value for long-term investors in the company. And I love buybacks much more than dividends. But United Health does have a dividend. It's only 1.5%, which isn't too much, but they have been growing this dividend rapidly from 3 cents in 2009 to $8.80 for 2025. This is insane growth for the dividend. And if you hold it for a long time, if you have dividend growth, the yield on cost will end up being much higher. And it's a beautiful thing for dividend growth investors. Now, for my valuation model, I'm going to take the $26 that they're expecting versus 26.50, which is the lower end of their guidance. I believe this is, a good to be conservative. And if we look at the average and the expected earnings per share growth of the company, they used to grow around 13%, 10%, 13%, 14%, 15%. So I believe 13% might be the best case scenario, but I believe it's fair for UNH over the next 5 years for me to use 13%. So all I did here, I took their own guidance for 2025, which is $26, and I took in $26. Then for the 4 years after 2025 to get 5 full year of profitability, I used 13% earnings per share growth, which I believe is fair. In total, I got $42.39 per share for 4 years from now, or 5 years in total would be by 2029. And if I look at the company's price to earnings multiple, it has traded at a mean multiple of 17 times earnings. From 2013 to now, the mean multiple has been 17 times earnings. It traded as high as 25 times and as low as 9.5 times earnings. And I believe that was in COVID. And the current multiple is 19 times earnings, which I believe is elevated. Now, for my valuation model, I'm going to take the $42.39 and we take in $42. and 39 cents per share. I'm going to first do the best case scenario, which is a current multiple of 19 times earnings. I don't believe UNH is going to 20 to 25 times earnings. I think that would be too optimistic. So I think 19 times earnings is like the best case scenario. So if I time it by 19 times earnings, I would get $805 per share on UNH around 5 years from now. But normally, this is really not a lot. And if I divide it by the current price, would be around 450. So the total upside on UNH over the next 5 years is like 78%. 78% over the next 5 years is really not enough to beat the S&P 500 or any kind of good returns with the company. So for me personally, I try to aim for a double every 5 years or a 15% CAGR. And if I want to double my money with UNH over the next 5 years using 19 times earnings, I would have to buy UNH around $402 per share just to get it double every 5 years on 19 times earnings. And if I use 17 times, it's even worse. If I use 42, 39, and I time it by 17 times earnings, then the price of UNH 5 years from now will likely be close to $720. This is nothing. If I want to double my money on 17 times earnings, which is a mean multiple, then I would have to buy UNH at $360 per share. So $360, or I should say $400 per share, which is my best case scenario, is around 11% from here. And for me personally, I wouldn't be buying UNH unless it hits $400 per share or below. If it does get there, then I would not be overpaying for the stock and I would be buying it somewhere near my fair value estimate, which I believe will most likely be accurate. Now, the only problem is that was a major drop on UnitedHealth stock, and I don't know if the stock is going to go to $400, if it's going to go to $360. But for me personally, the way I look at it is there's so many better opportunities. Google is like 17 times. Amazon is 17 times operating cash flow. There's so many different opportunities in the market. So I shouldn't be in rush to buy UnitedHealth. I set up a price alert on $400 per share. If it gets near my fair value or below, then I consider buying UNH. But if it doesn't get there, then I couldn't care less. I just let it go and I wait for another opportunity or another kind of stock that I find in the market. There will always be an opportunity. So I don't believe this is a time for me to FOMO in UnitedHealthcare when there's so many different opportunities. So my fair value on the best case scenario is $400 per share. You can say base to worst case scenario is like $360 per share. So I don't see the need to FOMO and overpay for UnitedHealthcare. But if you're, again, a very long-term investor, you don't mind averaging down 11-15% if it gets there, then maybe UNH is a buy. But for me, I think there's just better opportunities in this market. So that was just my opinion on UnitedHealth stock. I hope you enjoyed it. It wasn't financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.